Mike, I want to know if you think hedge funds start to de-risk going into next year. I just can't believe inflation doesn't smoke earnings soon. That's a good question, Rhino. I'm actually really interested to see what happens actually with if hedge funds start to de-risk again, because hedge funds just chased. And I do think you can see some de-risking going in towards the end of the year. But okay, so here, let me explain why I'm kind of like, let me explain why. This move that you have seen in the market. Okay, I'll just show it to you guys. What this move was, without any question of a doubt, is what we call chasing performance. What that means in the hedge fund world is a hedge fund manager is caught off sides. Caught off sides means they're not positioned the right way. They're positioned for the opposite move. When a hedge fund manager realizes that they are wrong, most hedge funds are too big. They can't just turn the switch like in one day. It takes them time to sell down positions and then reallocate capital to other positions. You're talking about hundreds of millions or tens of billions or even hundreds of billions, depending on the hedge fund, of dollars that need to be sold in one place and then bought and allocated in another. That process takes time. When you came into 2023, we had the biggest defensive positioning in the hedge fund industry that we've seen in over 2 decades. What does that mean by defensive positioning? This defensive positioning means that it means your cash position. So like if a hedge fund is, usually hedge funds will never be 100% invested. There's always a 5% or something, or 5 to 10% cash buffer, where 5%, where they can do things with. They always have some cash on hand. And then it becomes a matter of, if they want to do something, they'll take profit off from somewhere and they move capital to somewhere else. But coming into 2023, hedge funds had a much higher percentage of cash than they normally do. You also had, coming into 2023, the most hedge positions that they normally will see. Hedge funds, the true original meaning of a hedge fund is supposed to be a hedge, right? So it's like, if you're invested long in the markets, the idea was you would hedge the position by being in a hedge fund, right? Because in case things go south, you can offset your long investments. That was the true but that is no longer the case. Okay, they still use the term hedge fund, but hedge funds are not actually. Some are straight hedges, but the majority of hedge funds right now are just for-profit generate hedge funds. They're not meant to be a hedge against the market like the original intent was supposed to be. Now it's just, hey, I'm a great investor. Give me all of your money and I'll make you money. However means necessary that they do that, they do that. So what happened coming into 2023 is hedge funds actually had a lot of hedges where they either were short on futures contracts, or they were in put options, or they were in defensive stocks rather than technology stocks. There was a very, very large underweighting in technology stocks coming into 2023 because everybody anticipated a recession in 2023 and everybody anticipated a downward move in the markets. So once we got to and then the banking crisis happened. When the banking crisis happened, when Silicon Valley went under, it was like flashing green light for recession. Even the most bullish analyst on Wall Street said, yeah, this really isn't good. Even Tom Lee from Fundstrat is extremely bullish. And he was at the beginning of this year, he was saying, yeah, I think we're going to go to all-time highs. The banking crisis happened and he's like, yeah, this is not good. I actually need to change my thesis. I got to change my price target for the SPY. But then the banking crisis came and the banking crisis went and the economy still held. And when the economy still held, then you had the Fed meeting in May. The inflation data started. This is when inflation started to come down, right? This is when you first started to see under expectation inflation data. The Fed comes out, raises rates, but gives a little bit more of a dovish tone, talking about the economy. The jobs market still holds up. Unemployment went down to 3.6. Then it went down to 3.5. And hedge funds at this point in time realized, shit, it's May. Now it's June and you still have 3.6% unemployment. Inflation's coming down faster than we had anticipated. The jobs market is still held up and we just survived another round of earnings and the banking crisis was not contagious. We are not having a recession in 2023. That realization came at the very end of May. And all of those hedge funds that had more cash than normal and had hedges had to readjust their positioning quickly. And when that happened, you got that rally in the stock market that lasted 2 months, June and July. That's how long it took for hedge funds to get the cash they had on the sidelines into the market, and they had to get off their short positions. And then that's what helped propel the markets to the new highs. Now you go in towards the end of the year, and there's a lot of headwinds coming up on this market. You've got student loan payments are starting back up in September. What's that going to do to the consumer? That's $380 a month, I think, is the average student loan payment. So call it between $300 and $400. That's $300 to $400 a month that the consumer does not have any more to spend. That's a lot of money. That's a lot of discretionary spending. That's two nights out to dinner, right? That's a sporting event. That's a concert, right? Like, these are things that the consumer is not going to be, that's an extra $300 that's not going to be spent on Amazon. That's an extra $400 that's not going to be spent at Nike or Lululemon or Home Depot. It's going to be spent on paying back their student loan. What else do you have? So now you have the student loan payment that starts to get paid back, but what else is there? Well, now my auto loan, my car payment is significantly higher. 2-3 years ago, your interest was $50 or $60 a month. Now it's $200 just on interest. $200 to $250. Anybody that's on the live stream that works in the car business, you guys know what happened with interest rates and how much interest now factors into a lease payment. You guys know how all the lease programs work. Anyone that's in the car business, a car that used to cost $500 a month now costs $750 for the exact same car. All your rent prices have gone up. If you were paying $2,500 a month in rent, now you're paying $3,000, $3,200. And on top of all that, you have interest on your credit card debt is also higher. So now the rollover interest on your credit card is higher. And by the way, now you got to start paying back your student loan. That's going to be tough for the consumer. That's going to be real tough for the consumer. What does that do towards the end of the year? It's going to be tough to tell because you have the COVID savings is due to run out in October. Student loan payments start back up in September. So you might get to like October, November, and the consumer might really start to slow down, but then it's the holidays and people spend money during the holidays. So it might be tough to see that weakness until you get into next year. Because once you get into next year and the holidays are gone, once the holidays are over, you might have the consumer really tighten up. And maybe the recession comes next year. So Rhino, it's a great question. I don't know if you're going to see that de-risk from hedge funds this year because they just chased back in. You might see the market hold up going into the end of the year, and then maybe it starts to pull back really early in the first quarter of next year. That's certainly a possibility. We have to keep our eyes on, hey, is inflation back at 2%? You know, is unemployment still underneath 4? Because if unemployment stays underneath 4, then the market's not really going to pull back that much. But if you start to see unemployment go to 4, 4.2, 4.4, then yeah, market's pulling back.